yet incredibly fragile businesses on the face of the earth. You probably think you have a pretty good handle on how a bank operates, but the reality is this wild, high-stakes balancing act of profit, extreme leverage, and the ever-present threat of total collapse. Okay, let's dive into this with a really simple question. Is your money actually sitting in a vault right now? I mean, most of us picture a bank as this highly secure physical storage locker, right? You bring your paycheck in, they guard it with heavy steel doors, and you take it out when you need to buy groceries. But we need to shatter that illusion right off the bat, because that is not a bank. That's just a locker. So if the secure storage room is just an illusion, what's the reality? Well, a bank is actually an income-producing machine. Think about it kind of like a bakery. A bakery takes raw flour and manufactures bread. A steel mill takes raw iron and turns it into car parts. A bank? A bank takes your raw deposits and manufactures credit. Every single dollar you deposit isn't just sitting in a box with your name sharpied on it. The second it arrives, it gets sent straight to work. And this whole system operates entirely on one massive, calculated assumption that not everyone is going to want their money back at the exact same time. Let's actually walk through the exact math of how this builds into the broader economy. This is the concept of fractional reserve banking. Step 1, you walk in and deposit a crisp $100 bill. Step 2, historically speaking, the bank holds on to about 10% in reserve. Step 3, they turn right around and lend out the remaining $90. Now, step 4 is where the magic really kicks in. The borrower spends that $90. The person who gets it deposits it into their own bank, which then keeps $9 and lends out $81. This cycle just keeps repeating until that single original $100 bill multiplies through the economy to become nearly $1,000. It feels like magic, but honestly, it's literally just math. Now, before you pause this and rush out to start your own bank to capture some of that multiplying money, we really need to talk about the price of admission, because it is a brutal reality. Before you even unlock your front doors for the first time, before you take a single deposit or make your very first loan, you have already burned through millions of dollars and years of your life just getting permission to exist. You're facing a regulatory gauntlet that is no joke. We are talking 1 to 3 years of intense, agonizing paperwork. You've got to get a federal or state charter plus approval from the FDIC. And they do not just hand these things out to anyone who asks. To start a small community bank, say one capable of making $100 million in loans, regulators demand a massive cash cushion. We're talking $10 to $15 million of your own personal capital. It absolutely cannot be borrowed. It can't come from your future depositors. It has to be yours, free and clear. And okay, let's say you get open. The daily costs are just staggering. Even before you earn a single dollar of interest, you are practically bleeding cash just to keep the lights on. You got huge payrolls for loan officers and management. You're pouring an absolute fortune into cybersecurity and core tech, because let's face it, a single data breach can literally destroy you overnight. You are funding armies of compliance teams and lawyers to navigate the red tape. And on top of all of that, you have to proactively set aside a chunk of your own money. These are called loan loss provisions, just to cover the borrowers that you fully expect are going to default. So you're probably wondering, how does a bank actually survive this massive overhead? Well, it all comes down to this, the spread. Or, if you want to be technical, the net interest margin. It is a very simple but incredibly powerful mechanic. You borrow money cheaply from your depositors and you lend it out expensively to your borrowers. The bank just sits comfortably right in the middle, and the difference between those two interest rates is the absolute engine of the entire money-making machine. But, over the decades, banks realized they couldn't just rely on loans. They evolved. They figured out how to collect a toll on almost every single transaction you make. Think about the massive revenue streams generated completely outside of traditional lending. Sure, you have the spread as your biggest slice of the pie, but then there are overdraft and account fees. Get this, those generated nearly $10 billion across banks and credit unions in 2022 alone. Add in card interchange fees, that's every time you swipe a debit card at the grocery store, plus wealth management and investment banking. They've built an absolute empire out of fees. And this brilliantly illustrates what happens when you scale that machine all the way up. $58 billion. That was JP Morgan Chase's record-breaking net profit in 2024. Not revenue, guys, net profit. That is the highest annual profit in the history of American banking. The sheer scale of this industry is just unbelievable when everything is running smoothly. So how exactly do they get to those massive numbers? The secret ingredient is leverage. Leverage basically means operating almost entirely on other people's money to generate massive returns on your own small layer of equity capital. And this is exactly what we call the leverage trap. If a bank uses its depositors' money as the raw material to fund all these loans, it can easily generate 22% returns on its own equity. I mean, you are literally getting rich by utilizing someone else's cash. Now, what's really fascinating and kind of scary is how quickly that exact same leverage can completely turn on you. Let's put this into perspective. Take a community bank with $15 million in capital.
In a good year, they have a healthy 3% net interest margin, reasonable loan loss provisions, and boom, they yield a nice $620,000 net profit. But in a bad year, things flip instantly. If interest rates rise by just 2% across the board, your depositors immediately demand higher rates on their savings, completely crushing your margin down to 1.5%. Or maybe a mild recession hits, and your loan loss provisions suddenly spike up to $1.5 million. Out of nowhere, you are facing severe losses. A couple of bad years in a row, and your entire hard-earned capital cushion is just wiped out.
And that brings us to the absolutely terrifying part of this business. What happens when the trust breaks? Because remember, leverage amplifies the bad years just as intensely as it does the good ones. We've talked a lot about this steady, predictable profitability, but when the math turns against a bank, it doesn't just slowly decline. It collapses in sheer, unadulterated panic. Take a look at the fall of Washington Mutual back in 2008. CEO Kerry Killinger spent 17 years building WAMU into an absolute giant, eventually holding $188 billion in deposits. But they had leaned really heavily into subprime mortgages. When Lehman Brothers failed on September 15th, confidence in the housing market just completely evaporated overnight. Depositor panic spread like wildfire. Over just 10 days, terrified customers yanked out $16.7 billion. By the night of September 25th, the FDIC had to step in and seize the entire bank. 17 years of building a national giant completely vanished in exact 10 days. So the crucial point here is that this collapse risk isn't even always tied to bad loans. Fast forward to Silicon Valley Bank and their fatal mismatch. As the tech sector was booming, SVB's deposits literally doubled, jumping from $62 billion in 2020 to a staggering $124 billion in 2021. SVB took those booming short-term deposits and parked them in long-term government bonds. I mean, it sounds super safe, right? But when the Federal Reserve aggressively spiked interest rates in 2022, the value of those older long-term bonds tanked. That left SVB sitting on an agonizing $17 billion in unrealized losses on paper. And that exact mismatch led to a terrifyingly fast death spiral. Get this. It took exactly 44 hours to destroy a bank that had been successfully operating for 40 years. On March 8th, SVB announced a loss on bond sales because they were desperately trying to raise more capital. That was the trigger. By March 9th, venture capitalists started texting each other. Panic was spreading at the literal speed of a group chat, leading to an attempted withdrawal of $42 billion in a single day. By March 10th, California regulators stepped in and seized the bank. They weren't destroyed by sketchy loans. They were destroyed by interest rate risk and hyper-connected fear. Which really brings us to this incredibly stark realization. A bank can be technically solvent one morning and facing a fatal run by afternoon because enough people decided simultaneously they were worried. This right here is the central structural flaw of the entire banking industry. The math on your spreadsheets, those healthy net interest margins we talked about, the mandatory capital buffers, they all mean absolutely nothing if the customers get scared. At the end of the day, a bank is really just a machine that turns trust into money, right up until the trust runs out. It's this fascinating, incredibly precarious balancing act. So I want to leave you with a thought as we wrap up this explainer. The next time you open the banking app on your phone to check your balance, take a really good look at that number. And then ask yourself, what happens to that money if everyone else logs in and decides to withdraw everything today?